Hello folks, Steve Lentz here with Discover Options here at Option View. Welcome to this presentation of three different market timing reports for advanced options traders, all three of them with regards to the S&P 500. This is for Friday, December 1st, getting ready for Monday, December 4th. Presented material today is for educational purposes only. It should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Before we get into these three reports for advanced options traders, please consider subscribing. Just click the button. That way you will get alerted when we come out with new videos. Also, we have a free ebook for those of you that would like this. Just click the link, give us your information. We will get this free ebook out to you. Simple Steps to Options Trading Success, co-authored by myself and Jim Graham. We will give you three reports today: the S&P 500 Condor Butterfly Timing Report, the Bull Put Spread Timing Report, and then the Directional Likelihood Report, all three with regards to the S&P 500. All three reports require that we take a look at the market condition as it exists currently in the S&P 500. Let's take a look at three different dimensions that define our market condition: price action, the trend, and then the stochastic situation. Price action wise, Thursday was an upswing day, and then Friday was a big downswing day with a lower low and a lower high. And that's how we're going to define it: higher high, higher low. That's the Thursday's upswing bar. Friday was a lower high and a lower low, a downswing bar. Okay. Now all that price action took place when we are in a trend. We are above the 50-day simple moving average in the SPX. And then we go to the 15-3 stochastic. We are in overbought territory between 60 and 100. And it is trending downward underneath the 3-day simple moving average of that stochastic, the %D. So when you take all three of these dimensions added together, you get a market condition that has occurred roughly 155 times since January of 2000. That's a pretty decent population. I'm very happy with that. It's a lot better than dealing with a very unique condition with just maybe a dozen or so. Something extremely rare. This gives us a more robust set of a robust population to really kind of have a bit more confidence in the statistics that come from this. So let's go to those that trade Condors and Butters. This first report answers the question, based upon the current market condition, is now a good time to implement a Condor or Butterfly campaign? All right, is now a good time to do this? All right, so here's the report. Since Jan of 2000, there's been about 4,528 closes of the S&P 500. All right, over 4,500. Of those 4,528, 65.7%, almost 2/3, have been favorable bars for selling option premium, neutrally like that, like Condors and Butters, where the actual 21 bar subsequent movement was less than the SIBO skew adjusted implied movement coming from the VIX. All right, again, 2/3 of the time we've had bars that were favorable for doing these strategies, and we define that in that the subsequent 21 bar movement, 30 days, 30 calendar days, 21 trading days, the subsequent 21 bar movement was less than that which was being implied by the option prices vis-a-vis the VIX, skew adjusted VIX. Okay, now also during that time, since Jan of 2000, our current market condition has occurred 155 times. Of those 155 occurrences, 75.5% of the bars were similarly favorable for premium selling through these strategies. Now, 75.5 is more than 2/3, so this implies then a premium selling edge of 9.8%. Premium selling edge of 9 point. Instead of just 2/3, you have over 3/4 of the bars favorable amongst our population of 155, matching our current market condition. So statistically then, it's more likely than usual that our current market condition will end up being a favorable one for selling premium through delta neutral strategies like Condors and Butters. Okay. All right, so that is that report. Let's go now to those that like to lean your strategies bullish, maybe leaning your Condors bullish, or your Butterflies bullish. We have the bull put spread timing report. Now the premise here is that we're going to sell put premium a standard deviation away about 30 days out. Standard deviation away about 30 days out. So here's the report. Okay. We have those 4,523 daily closes of the S&P 500, 4,528. Of those, 83.2% were favorable for selling put premium because the actual 21 bar downside movement was less than what the SIBO skew adjusted implied movement to the downside was. Okay? Again, so what this means is that 83.2% of the time, the market does not move down and hit that standard deviation level to the downside. 16.8% of the time, it does in fact move down enough that it hits the 1 standard deviation mark at the 30-day level, sometime within those 30 days. Okay, or 21 bars, same thing. All right, so 83.2 is the market benchmark from Jan 2000 forward. Now, let's take a look at our market condition. Out of 155 occurrences, okay, 86.4% of the time, the bars were similarly favorable for selling put premium a standard deviation out like that. That implies a small selling edge, a put premium selling edge of 3.2%. Statistically, it's slightly more likely than usual that the market condition we have now will end up being a favorable one for selling that out of the money put premium 30 days away, a standard deviation out of the money. Okay, so there's that report. And finally, we go to the market likelihood report. This answers the question, based upon the current market condition, where's the market likely to go? Up, down, or wobble around a little bit? And to answer that question, we have to use what we call distribution bands. Distribution bands, here's what they are. You have the close, okay, and I know I do this every week, but I really try and rip through it pretty quickly. You have the close, and then you have the distribution bands, a standard deviation away, both to the upside and the down. Now, here are the 5-day bands. These are set 5 days out, a standard deviation to the upside and downside. Notice that the upside band is closer to the close than the downside band. That's because we skew adjust our VIX reading here. And we do that because the out-of-the-money calls have a lower implied volatility than the out-of-the-money puts, right? So that's why the bands are asymmetrical like this. And the question is in the next 5 days, is the market going to hit the upper band, the lower band, or hit neither of them? Hit neither of them. And we do this not only for 5-day bands, but also for, oops, time out here. Okay, we do it also for the, okay, come on, I'm trying to get this to go. We do this also for the 10-day bands, and also we record these statistics for the 15-day bands. And when you take a look at this chart, take a look at the top, the historical distribution, out of 4,528 closes, the upper 5-day band gets struck 28 or 21.4% of the time. Out of 4,528 occurrences, 21.4% of the time it hit the upper 5-day band. The upper 10-day band was 15.8, upper 15, 14.9. The lower bands, the lower 5, 16.4, 16.6, 19.4. Okay? So that is the benchmark distribution of price. Looking at these bands like that. Now, what we do is we go to our current market condition, okay, and we note that we had 157 in this particular look back, 157 occurrences. The upper 5-day band out of those 157 got struck 12.1% of the time. That's quite a bit less than the benchmark of 21.4. That's why you could see that negative 9.3% underneath it. It's a pretty strong difference. The upper bands did not get struck near as often as the benchmark. You see that? In fact, not only did the upper three bands not get struck near as often, but the lower bands did not get struck near as often as the historical benchmark. This is a picture of lower market volatility. Lower market volatility. Now, these are not leaning one way or the other. It's kind of an equal distribution in terms of how less often the bands are getting struck. So, clearly, the bands are, look at that. I mean, big differences from the benchmark. Now, what I like to do is divide these up into those occurrences where the market went above, in this case, Friday's high, or below Friday's low. That way, when Monday comes, you'll be prepared. If market goes above Friday's high, you know what the distribution is in that particular scenario. And in this case, if price goes above Friday's high, okay, that occurred 59 times in the past. Look at this. All 6 bands got struck dramatically less often, except this one, the lower 15-day band, was about the same. Other than that, the other 5, a dramatic difference here. And then if price goes below the low of Friday, which in this case it's really far away, but you can see here, again, the distribution of price is really one, historically, we see less volatility. Now, does it mean it's not going to hit the bands? No, you can see that occasionally it does, but far less often than what is just the historical benchmark. Okay, so again, a picture of likely, the market likely will experience lower market volatility in all 3 time frames, 5, 10, and 15 days. No guarantees, but based upon history, we have a likelihood there that it'll be less volatile. Okie dokie, I'm Steve Lentz with Discover Options. Thanks for joining us today. We'll see you next week. Take care. Bye-bye.